Nine Entertainment Co. is a leading Australian media company with roots tracing back to 1956 when TCN9 was established. After this, it later formed a part of the PBL Media Group by the Packer family in 1994. Rebranded in 2006, Nine merged with Fairfax Media in 2018, integrating major assets like the Sydney Morning Herald, The Age, and the Australian Financial Review. Nine's revenue streams are diverse, evident in the EBITDA split FY24 pie chart. Its primary sources are its flagship free-to-air broadcasting channel, Channel 9, its online/digital content distribution through 9.com.au, as well as its subscription-based streaming services of 9Now and Stan, and finally its printed and digital publications like the Sydney Morning Herald. It also earned $395.7 million in revenue and from a 60% stake in Domain. Nine's broad range of media services has significantly expanded its audience reach. Traditional platforms primarily engage viewers aged 25 to 54, with Nine holding a 40.08% share in this demographic. In contrast, its digital and streaming platforms appeal more to younger audience aged 16 to 39, who prefer on-demand, mobile-friendly content. Notably, 56% of 9Now viewers fall within the 16 to 39 age range. Live broadcasts of major sporting events and real-time programs are key drivers of youth engagement. Flagship shows like Math, The Blob, and major partnership with the NRL State of Origin have further expanded Nine audience across age groups.
The financial performance analysis examines Channel 9 Entertainment's profitability from 2022 to 2024, benchmarked against the industry average and a peer company, Seven West Media. The key profitability ratios, net profit margin, operating margin, return on equity, and asset turnover, highlight a downward trend in performance over the 3-year period, raising concerns about the company's operational and strategic position in the entertainment industry. This chart shows the declining net profit margin of Nine Entertainment and Seven West Media from 2022 to 2024. Both companies experienced a steady drop, primarily due to the tough external conditions in Australia. Factors include Meta's potential exit from the News Media Bargaining Code and increased scrutiny by regulators on gambling advertisements. Despite events like the Olympics in 2024, profitability still fell. Nine Entertainment dropped from 13.9% in 2022 to 5.1% in 2024, while Seven West Media went from 13.7% to 3.2%. The industry as a whole reflects a downward trend in profitability, highlighting the increasing challenges. This chart highlights the decline in return on equity, ROE, for both Nine Entertainment and Seven West Media from 2022 to 2024. Nine's return on equity dropped from 16.9% to 8.5%. While Seven West Media saw a sharper fall from 80% to 11.2%. The decrease is tied to declining net profits in an unfavorable macroeconomic environment. Despite acquiring Fairfax Media, Nine didn't see improved profitability compared to Seven West. Nine's return on equity is more stable and closer to the industry average. Overall, the trend indicates a broader industry challenge in effectively using equity to generate returns. In relation to asset turnover, however, this graph shows the asset turnover trends for Nine Entertainment and Seven West Media from 2022 to 2024. Nine Entertainment maintained a relatively stable asset turnover, dropping slightly from 0.79 to 0.76, supported by steady advertising revenue. Seven West Media also experienced a minor decline from 1.1 to 0.94 in 2024. In 2024 though, Seven held $1.48 billion in total assets compared to Nine's $4 billion. Both companies' minimal fluctuations suggest a conservative and strategic asset diversification approach. This stability reflects the industry's focus on maintaining operational efficiency while adapting to different market opportunities with measured asset deployment.
Let's begin with an overview of Nine Entertainment's liquidity performance. Looking at the current ratio, there is a slight improvement from 0.98 to 1.002. While this exceeds the basic solvency threshold of 1, meaning Nine can just about cover its current liabilities, it still falls short of the industry average of 2.1 and Seven West's 4.4. This weak buffer limits the ability to absorb short-term financial shocks. While we compare this directly with Seven West Media, the gap becomes clearer. Seven West maintains a much stronger current ratio, suggesting healthier cash flow management and better preparedness for intermediate obligations. Nine's performance here suggests limited liquidity and greater short-term risks. Now, moving on to quick ratio, which offers a more stringent view by excluding inventory. Here, Nine's ratio declined from 0.63 to 0.53, dropping further below the industrial average of 1.9 and Seven West's 0.92. This points to a heavier reliance on less liquid assets, raising concerns about Nine's abilities to meet urgent liability without delay. At the same time, Seven West Media has seen an improvement in its quick ratio. This widening gap may be attributed to stronger internal cash control or operational efficiency. Whatever the cause, it underscores Nine's ongoing struggle with the liquidity management, especially when compared to its peer company. When we take all this together, both the current and quick ratio, it becomes clear that Nine faces a growing short-term financial risk. Without intervention, it may need to turn to external funding, increasing dependence on debt and limiting strategic flexibility. Moving on to solvency, we observe that Nine's debt-to-equity ratio rose sharply from 0.9986 to 1.39 in just 1 year. Although this is still within the acceptable range of 1 to 1.4, the pace of this increase may be a red flag for long-term investors concerned about over-leverage and financial stability. Worth noting that Seven West Media reports a significantly higher debt-to-equity ratio of 2.66. However, this may represent an outlier rather than a realistic benchmark. Compared to moderate peers such as Sky News, Nine Entertainment's capital structure appears more conservative, suggesting a strategic preference for maintaining equity balance. Looking now at that to exit ratio, Nine's figure increased from 49% in 2022 to 55% in 2024. This steady rise reflects growing debt use, yet still falls within the healthy range of 40% to 60%, and is closely aligned with the industry average of 54.68%. It suggests Nine is managing its leverage reasonably well, neither underutilizing or overexposing itself to financial risk. Compared to Seven West Media's high 72.7% debt-to-asset ratio, Nine Entertainment's 55.41 shows a more conservative financing strategy. Nine Entertainment closely mirrors the industry average, signaling a better financial stability and lower risk. While Seven West may see higher return, Nine Entertainment's approach offers a more resilience in volatile markets. Overall, Nine Entertainment shows a balanced but concerning capital profile. Its debt-to-asset ratio reflects conservative financing, offering some protection against financial shocks. However, rising leverage and declining liquidity signal weakening short-term flexibility and growing reliance on external funding. In conclusion, while Nine Entertainment remains competitive in the media sector, its financial position highlights emerging risks. To maintain investor confidence, the company must adopt proactive strategies such as improving cash flow, reducing short-term liabilities, and maintaining a more balanced capital structure.
One risk identified in Nine's 2024 CEO's address is increasing regulatory intervention, particularly surrounding the potential abandonment of the News Media Bargaining Code by Meta. The code was designed to address bargaining power imbalances between Australian news organisations and large digital platforms. With 62% of total revenue coming from digital publishings, this change could reduce Nine Entertainment's bargaining power and revenue streams, especially from digital platforms and advertising partners, which form a critical part of its commercial model. This would directly impact Nine's financial performance, profitability, and efficiency ratios. With the potential of Meta pulling out of the code, Nine may lose crucial revenue streams that previously supported its digital publishing and strengthen Nine's profit margins with minimal associated costs. Decline in high-margin digital revenue would reduce net profit margin, contributing to the downward trend in return on equity, which is already declining from 16.8 in 2022 to 8.5 in 2024, lowering overall earnings available to shareholders. Additionally, reduced digital revenue would worsen return on assets, which has also dropped from 7.6 to 3.4% over the same period. By decreasing net income without a proportional reduction in asset base, the risk compounds Nine's current challenges of underutilizing its assets and existing operational inefficiencies, highlighted in the previous financial analysis in question 2. This also impacts Nine's financial position. Low profitability reduces retained earnings, weakening shareholders' equity and the company's capital base. To maintain operational capacity or invest in new digital strategies, Nine may be forced to take on additional debt, thereby increasing its liabilities. Over time, the absence of compensation from digital platforms like Facebook and Instagram could limit financial flexibility and responses to future risks.
A prima facie look at the free-to-air broadcasting entertainment industry in 2024 reveals 3 commercially and financially comparable candidates to Nine Entertainment codes, which involve 10 Network Holdings Property Limited, Seven West Media Limited, and Southern Cross Media Group Limited. Each is a diversified media conglomerate with strong positions in free-to-air broadcasting, streaming, and multi-platform content. However, of these, Seven West Media is the most comparable to Nine, both operationally and financially. Seven's size, which is measured by revenue, staff, market, and enterprise value, is the closest to 9, indicating similar operational capacity and financial scope. Both companies rely on broad-reaching programming and target largely overlapping demographics across all age and income groups. The main distinction lies in streaming. 9's platforms, Stan and 9 Now, include paid subscriptions, whereas 7's 7plus is fully ad-funded. Notably, both have experienced declining financial performance in recent years, reflecting shared exposure to weakened advertising markets and digital competition. By contrast, Southern Cross Media operates primarily in regional radio and affiliate TV, with lower market capital and limited digital reach. This makes it structurally and financially misaligned with 9. And Network 10, however, whilst more aligned in product offering, is a privately owned subsidiary of Paramount and lacks public financial transparency, making direct comparison to publicly listed 9 fundamentally flawed.
Unfortunately, Network 10 is a private subsidiary of Paramount Global, which means its financial data lacks transparency and comparability to provide any meaningful valuation for 9 Entertainment's equity. Nonetheless, to estimate a defensible valuation range for 9 Entertainment's equity, we applied 2 equity multiples and 2 firm-level multiples drawn from publicly listed comparators in 7 West Media and Southern Cross Media. The 2024 price-to-earnings multiple of these companies reflects market expectations of earnings, and when multiplied by 9's 2024 net income of $134.9 million, yielded valuations of $3.64 billion and $2.97 billion respectively. These were calculated using 7 and Southern Cross's trailing price-earnings ratios. To temper the volatility inherent in price-earnings-based methods, we also applied the peer company's price-to-book multiples, which, when multiplied by 9's book value equity of $1.785 billion, provides equity valuations which were significantly lower at $857 million and $1.25 billion, respectively. At the firm level, we applied EV revenue and EBITDA multiples, using 9's 2024 revenue of $2.62 billion and EBITDA of $405.4 million, of which we then subtracted $157.54 million, which represented 9's cash and cash equivalent assets. We derived the enterprise values, which we then applied market value capitalization ranging from $1.07 billion to $2.92 billion, respectively. Overall then, these 8 valuations produced a maximum valuation of $3.64 billion and a low of $857 million, which generated a midpoint of $2.25 billion. This average market value equity was then divided by 9's 1.586 billion outstanding shares in 2024 to produce a projected average share price of approximately $1.42 in 2024. Each method was chosen for its distinct analytical lens. The PE and EV EBITDA capture profitability and operational performance, while the PB and EV revenue multiples anchor the valuation to structural fundamentals. The inclusion of all 4 methods ensures our estimate incorporates both 9's recent earnings decline and the strength of its asset base and content portfolio. The width of the valuation range, being from $856.8 million to $3.64 billion, is primarily attributable to the divergent theoretical assumptions underpinning each multiple. The price-earnings multiple yields the highest valuation because it capitalizes on 9's current earnings, which, although diminished, are still positive. However, given that 9's net income has declined over 60% between 2022 and 2024, this figure likely overstates sustainable profitability. In contrast, the price-book value method produces a much lower valuation due to the conservatism of asset-based pricing, particularly in media sectors where intangible assets like content rights, brand equity, consumer loyalty, and goodwill are substantial yet unrecorded. The firm-level enterprise value multiples introduce further variation. The EV revenue assumes similar margin efficiencies across firms, while the EV EBITDA presumes normalized capital structures and depreciation practices. These assumptions may not hold, particularly given 9's hybrid operating model and its heavy investment in subscription streaming relative to peers. Thus, although the midpoint of $2.25 billion appears statistically balanced, it likely overstates true value amidst sector contraction and advertising decline. A 15% downward adjustment is therefore justifiable, yielding a revised midpoint of $1.91 billion, which better reflects 9's eroding margins, competitive uncertainty, and the market's caution towards traditional broadcasters in digital transition.